Most people assume that when a powerful financier faces a major criminal case, their financial world collapses overnight. Clients disappear, banks pull away, deals vanish, and the money stops flowing. That's how it works for ordinary executives and investors. But Jeffrey Epstein's story didn't follow that pattern. After his first arrest and legal fallout in the late 2000s, many expected his financial career to end permanently. Instead, something unusual happened. His public reputation took a massive hit, yet behind the scenes, his financial network kept functioning. And in some areas, it even expanded. Understanding how this was possible reveals something uncomfortable about elite finance. Money often follows access, not image. By the time of his first conviction, Epstein had already spent decades building connections across banking, wealth management, technology, and private investment circles. His power didn't come from running a public company or managing a visible hedge fund. It came from relationships. In elite finance, relationships function like infrastructure. They don't disappear just because headlines turn negative. If anything, private financial networks tend to move further underground when scrutiny increases. Epstein's system was built in a way that allowed him to remain useful to certain investors even as his public profile became toxic. One of the key reasons he could continue earning money was that his financial model didn't depend on mass clients. He never ran a large public investment firm with thousands of investors who could panic and withdraw funds. Instead, his work was concentrated around a small number of ultra-wealthy individuals and private deals. That kind of structure is surprisingly resilient. When your client list is tiny and relationships are personal, those connections can survive storms that would destroy traditional businesses. Epstein's influence wasn't built on marketing or reputation, it was built on access to specific people and opportunities. Another factor was that elite wealth often operates through long-term structures rather than short-term contracts. Epstein had helped design trusts, investment vehicles, and corporate arrangements that didn't automatically dissolve when his personal situation changed. These structures continued functioning because they were legally separate entities. Money inside them could still move, investments could still generate returns, and deals could still proceed. This separation between personal reputation and financial architecture allowed Epstein to remain involved in wealth flows even after his legal troubles became public. After his first conviction, Epstein began shifting focus toward private investments rather than traditional wealth management. He showed increasing interest in emerging industries, particularly technology and data-driven companies. In the mid-2010s, he was connected to funding rounds in areas like cryptocurrency infrastructure, blockchain projects, and advanced communications technology. These were sectors where investors often prioritize access to networks over public image. Startup finance, especially in its early stages, tends to operate through private introductions and informal relationships. Epstein still had those introductions. The technology investment world also operates differently from traditional finance. Venture capital and startup funding often involve smaller groups of investors making high-risk bets on future industries. In this environment, personal background can sometimes matter less than the capital or connections someone brings. Epstein's long history in elite financial circles meant he could still connect founders to wealthy backers, introduce investors to deals, or participate quietly through intermediaries. His role may have been less visible than before, but it remained financially relevant. Another industry that drew his attention after his conviction was the surveillance and security technology sector. This space sits at the intersection of government contracts, private investors, and advanced data systems. Companies in this field often attract interest from wealthy individuals looking to invest in future infrastructure. Epstein's involvement in projects linked to emergency communications technology and data-driven platforms suggests he understood where long-term financial growth might lie. He wasn't chasing quick returns. He was positioning himself in industries tied to national security, digital infrastructure, and long-term government demand. This shift toward emerging sectors reveals something about how elite investors think. While public markets react quickly to reputation damage, private investment networks often operate on longer timelines. If someone still controls capital or access to capital, they can remain useful even if their public image is damaged. Epstein's continued activity after his conviction suggests he still held value within certain financial circles, even if that value was no longer publicly acknowledged. There's also the reality that money itself creates insulation. When someone has substantial wealth already embedded in investments, those investments don't vanish overnight. Returns continue to accumulate, business entities continue operating, properties generate income, trust structures continue distributing funds. Epstein's financial ecosystem had been built over decades, and systems built that way don't collapse instantly. Even without new deals, existing assets could continue producing revenue streams. But evidence suggests he wasn't only relying on old investments, he was still pursuing new ones. Part of the reason he could do this lies in how private wealth networks function socially. High-level investors often operate in circles where introductions come from trusted intermediaries. If one member of the network continues to vouch for someone, doors can remain partially open. Epstein's long history with powerful individuals meant that even after his conviction, some pathways into deals or partnerships may have remained accessible. In elite finance, reputation isn't always determined by public opinion. It's often determined by the opinions of a small number of influential insiders. Another overlooked aspect is that controversial figures sometimes become more discreet rather than less active. After legal trouble, Epstein appeared to operate more quietly, focusing on private meetings and behind-the-scenes involvement rather than public financial roles. This type of repositioning is common in elite finance. When visibility becomes risky, influence often shifts into less visible channels. Deals still happen, money still moves, but the structure becomes more private. Epstein's post-conviction financial activity seems to fit this pattern. His continued involvement in financial discussions also showed that he understood the importance of staying intellectually connected to emerging markets. Even when not directly leading deals, maintaining knowledge about new sectors allows someone to remain relevant in investor conversations. Finance at the highest level isn't only about capital, it's about being part of the information flow. Epstein remained connected to conversations about technology, data, and future industries, which helped sustain his presence in investment circles. Ultimately, the fact that Epstein kept making money after his first arrest tells us less about him as an individual and more about how elite financial systems work. Wealth at that level doesn't function like a normal career. It's not tied to one employer or one public role. It's embedded in networks, structures, and long-term investments that continue operating even when the individual at the center faces serious consequences. Once someone has built those systems, they can keep generating financial momentum long after public trust disappears. The broader lesson here is that in global finance, reputation can matter less than position. If someone sits at the intersection of money, networks, and opportunity, they can remain financially active even under intense scrutiny. Epstein's ability to continue earning after his conviction illustrates how resilient private financial ecosystems can be. They're designed to survive political changes, market crashes, and sometimes even personal scandal. And that may be the most revealing part of the story. Epstein's continued financial activity wasn't just about one man's persistence, it was about a system where access, structure, and capital often outweigh public perception. In that world, money doesn't always follow reputation. Sometimes it follows the network, and as long as the network holds, the flow of wealth can continue.